If your mortgage renews in 2026, you could be paying an extra $1,000 every single month. And this morning, the Bank of Canada just confirmed it is not going down. Not a warning, not a prediction, a confirmation. The rate hold was announced this morning, and the message embedded in the bank's language is not ambiguous. Rates are staying where they are for the foreseeable future. And for 1.1 million Canadians whose mortgages are coming up for renewal this year, the financial wall they have been hoping to avoid just became permanent. The escape route they were counting on has been sealed. The relief they were promised by mortgage brokers, financial advisors, and optimistic headlines has been officially withdrawn. And the collision that economists have been forecasting for 2 years is now confirmed to be happening at full speed, with no last-minute intervention from the central bank to soften the impact. Welcome back to Canada Property Watch. We have spent the past several weeks exposing the exit tax series, the CRA audits, the TFSA traps, and the surveillance infrastructure closing around Canadian homeowners from multiple directions simultaneously. Today, we are returning to the mechanism that started all of it, the mortgage, because this morning's Bank of Canada announcement changed the financial reality for every household in Canada that is renewing this year. And the number attached to that change is not a number that most middle-class Canadian families can absorb without making decisions they never expected to have to make. Here is the number that defines this moment. In February 2021, the lowest available 5-year fixed mortgage rate in Canada was 1.39%. Today, following this morning's hold decision, the best available 5-year fixed rate is approximately 4.5%. That is a difference of 311 basis points. On a $600,000 mortgage with 20 years remaining, the monthly payment at 1.39% was approximately $2,390. At 4.5%, that same mortgage costs $3,170 per month. That is $780 more every single month, $9,360 more every single year, and on a larger mortgage of $750,000. A balance that is entirely common for a household that bought in the GTA or Metro Vancouver in 2021. The monthly payment increase at renewal exceeds $1,400, $16,800 per year. After tax, that is not money that disappears painlessly into a household budget. That is money that has to come from somewhere real. From the grocery budget that was already stretched by 2 years of food price inflation. From the retirement contributions that were already behind schedule. From the children's education savings plan that was underfunded to begin with. From the credit card balance that was finally getting paid down. That money is gone. Transferred to the bank every single month for the next 5 years because the Bank of Canada this morning looked at the economic data and determined that holding rates at 2.25% is the least damaging option available to it. But here's where it gets worse. And this is the part that most financial commentators are not saying clearly enough. That number assumes you act today. If you wait, hoping the environment improves before your renewal date, you may find yourself renewing into something more expensive than what is available right now. Because the Bank of Canada does not actually control your 5-year fixed mortgage rate. Most people do not know this. The overnight rate that the bank set this morning directly influences variable rate mortgages and floating rate products. 5-year fixed mortgage rates are determined primarily by the 5-year Government of Canada bond yield, which is set by the global bond market, not by the bank's policy decisions. And right now, the bond market is receiving signals that push yields upward rather than downward. The Iran war has injected significant inflationary pressure into global energy markets. Higher energy prices mean higher transportation costs, higher food prices, higher manufacturing input costs, and higher consumer prices across virtually every category of spending. The Bank of Canada's own statement this morning acknowledged that CPI inflation will rise in the coming months. A central bank watching inflation rise cannot cut its overnight rate, and a bond market watching inflation rise prices higher yields, not lower ones. The 5-year fixed rate available to renewing borrowers today may not be the floor. It may be a floor that is still falling, so the question is no longer will rates go down before my renewal date, The real question is whether you are already looking at the best rate you will see this year. And for a significant number of Canadians, the honest answer is yes. Let us build the profile of the household sitting with this news this morning. Let us call them Sandra and James. They live in Mississauga. In January 2021, they purchased a townhouse for $850,000. They put down 20%, leaving a mortgage of $680,000. They signed a 5-year fixed rate at 1.75%. Their monthly payment was $2,730. It was manageable. It represented approximately 28% of their combined gross monthly income of roughly $115,000 annually. The stress test was cleared comfortably. The bank approved the file without hesitation. Sandra and James felt financially responsible. They had saved for years for the down payment. They had not overextended themselves. They had bought a property they could reasonably afford at a price that felt, in the context of 2021, like a measured and sustainable decision. Every box was checked. Every rule was followed. Every approval was granted. Today, their renewal letter arrived. 4.59%. New monthly payment, $4,110. That is $1,380 more than they are paying now, every single month. And here is the part nobody warned them about. James was offered a buyout package at work in February as his company restructured under tariff pressure. He declined it. He is still employed. But the income security he felt 18 months ago has been replaced by a quiet anxiety that follows him to every team meeting and every one-on-one with his manager. Sandra received a performance review in January that was positive but contained no mention of a salary increase. Their combined household income is the same today as it was when they bought the house. The payment shock arriving in their mailbox is not arriving into a household whose income has grown to meet it. It is arriving into a household whose income has stood still while everything around it has become more expensive. And the payment is going up by $16,560 per year. To absorb this increase without reducing spending anywhere in their household, Sandra and James need approximately $23,000 in additional gross income. That is what the marginal tax rate arithmetic produces when you work backward from an after-tax monthly shortfall of $1,380. $23,000 additional gross income they do not have and are not expecting to receive. This is payment shock. It is not a theoretical risk. It is a mathematical certainty arriving in the mailboxes of 1.1 million Canadian households in 2026. And the Bank of Canada confirmed this morning that there is no cavalry coming. The psychological dimension of what Sandra and James are experiencing right now does not show up in any monetary policy report. It is the dimension of betrayed expectation. They were told to hold on. Their mortgage broker told them rates would normalize downward. Their financial advisor told them the central bank would cut aggressively in 2025 and 2026. The headlines told them relief was coming. They held on through 2 years of elevated payments. They canceled vacations. They deferred the renovation. They cut the dining out budget. They absorbed the sacrifice because they believed it was temporary. This morning, the Bank of Canada confirmed that the sacrifice they accepted as transitional is now their permanent financial reality for at least another full year. There is a specific kind of damage that comes not from a single piece of bad news, but from being told repeatedly that things will get better and then watching them not get better. Sandra and James are experiencing that damage today, and they are not alone. Some households will not survive this renewal cycle financially intact. That is not an overstatement for emotional effect. It is the arithmetic of what happens when a household's fixed housing costs increase by over $15,000 per year. In an environment where income growth is stagnant, inflation has already eroded purchasing power across every other spending category, and the employment market is softening. The money has to come from somewhere. When it stops coming from somewhere manageable, it starts coming from asset liquidation, retirement account withdrawal, and eventually from the forced sale of the property itself. Now, let us address what most Canadians do not understand about the mortgage renewal process and why that ignorance costs them significantly more money than is necessary. When your mortgage comes up for renewal, your existing lender is required to notify you a minimum of 21 days before your maturity date. Most lenders notify between 30 and 90 days before maturity. The renewal offer they send is their opening position. It is an automated rate generated by a pricing system with no knowledge of your individual payment history, your loyalty as a customer, or your current financial circumstances. The number in the renewal letter is the rate the lender believes you will accept without pushing back. It is not their best rate, it is their preferred rate. And there is a significant difference between those two things. Here is exactly what you say when you call. You call your lender and you ask for their discretionary rate. Not their renewal rate, not their current posted rate, their discretionary rate. Those two words signal to the bank representative that you understand there is a floor below the advertised number and that you are prepared to negotiate. Every major Canadian lender has a discretionary pricing range below their posted renewal rates. The gap between the posted renewal rate and the discretionary floor is typically between 20 and 50 basis points, depending on the lender and the competitive environment at the time. On a $600,000 mortgage over a 5-year term, 40 basis points saves you approximately $14,000 in interest payments. That money is available to any borrower who asks for it. Most borrowers never ask. The bank is not going to volunteer it. And there is a regulatory change from October 2024 that gives renewing borrowers significantly more leverage than they have ever had before in any previous renewal cycle. Uninsured mortgage holders can now switch lenders at renewal without being required to re-qualify under the mortgage stress test. Previously, even if you were simply moving your existing mortgage balance from one lender to another at renewal without borrowing any additional money, you were required to re-qualify at a rate 2 percentage points above your new contract rate. That requirement has been removed. This means that a borrower who could not qualify for a new mortgage under current stress test standards can still move their mortgage to a competing lender at renewal without a full application. This dramatically expands the competitive options available to renewing borrowers and creates a credible threat of switching that was not available in previous cycles. Your existing lender does not want you to know this. If you do not know, you can switch without re-qualifying. You have no leverage. The moment you understand that you can switch, the entire negotiation changes. We have seen borrowers in this environment reduce their renewal rate by between 0.3 and 0.5% simply by presenting a documented competing offer and asking their lender to match it. On a $650,000 balance over a 5-year term, a 0.4% reduction saves approximately $14,400 over the term. That is not theoretical. That is money that stays in your household rather than going to the bank. It is available to borrowers who do the work of shopping their file before the renewal deadline. It is not available to borrowers who sign the letter that arrived in the mail without making a single phone call. The timeline urgency is this: if your renewal date is within 90 days, you should be actively shopping competing offers right now, today. Not after the next Bank of Canada announcement. Not after you see whether the bond market improves. Today. Every day you wait after receiving your renewal letter is a day closer to your maturity date and a day of reduced leverage. Now, the moment your maturity date passes and you have not secured renewal terms, your mortgage moves to an open rate, which is typically substantially higher than any fixed term option. The 90-day window before maturity is your window to act. Once it closes, it does not reopen. For the Canadians watching this who are not in the renewal population this year, who rent, who have no mortgage, who were priced out during the pandemic years and chose to wait, this morning's announcement is a specific and measurable vindication of that decision. The rate environment that made the 2021 purchase prices appear affordable was always temporary. The Bank of Canada told buyers this directly and repeatedly during the pandemic period. The buyers who chose to believe that rates would stay low indefinitely or that normalization would be quick and painless are living inside the proof that neither of those beliefs was accurate. The payment shock arriving in their mailboxes is not a punishment for their decision to buy. It is the delayed consequence of a mathematical reality that the rate environment was obscuring at the time of purchase. Let us also address the broader market consequences of this morning's hold for the segments of the housing market beyond the renewal population. First-time buyers who were waiting for rates to fall meaningfully before entering the market are now looking at a rate environment that will not improve materially in 2026. Many of them will continue to defer their purchase decision. This creates a specific problem for sellers who need to transact. The inventory that has been building in the GTA and Metro Vancouver and Calgary requires buyer depth to clear. That buyer depth is not forming while rates remain elevated. Investors carrying negative cash flow on condos and investment properties are confirmed trapped for at least another full year by this morning's decision. The accumulated losses in the investor segment of the condominium market are substantial. At some point, those losses become unsustainable for a large enough number of leveraged investors simultaneously that the resulting forced sales reshape the pricing environment for everyone else. For Sandra and James, and for the 1.1 million Canadian households in the same position this year, here is the specific action plan that this morning's rate hold requires. Contact an independent mortgage broker within the next 14 days, not the renewal department of your existing lender. An independent broker who has access to multiple lenders and no financial incentive to place you with the institution that pays the highest referral fee. Ask specifically whether the October 2024 stress test exemption for lender switchers applies to your file. Ask for competing offers from at least 3 institutions and bring those offers back to your existing lender before you sign anything. Ask your existing lender for their discretionary rate and be prepared to walk away if they do not move meaningfully from their initial offer. Consider the term length decision carefully and model the payment and total interest implications of a 2-year, 3-year, and 5-year commitment, and be genuinely honest with yourself about whether the new payment is sustainable within your household budget without sacrificing necessities. There is one final dimension of this morning's decision that needs to be addressed directly because it affects the mental health and decision-making capacity of every household inside the renewal population. The Bank of Canada's communication strategy around this hold was deliberately measured and technical. What it means in plain language is this. The institution responsible for the cost of borrowing in this country has decided that its primary obligation right now is to contain inflation, not to rescue households from payment shock. That may be the correct policy position given the global inflationary environment. But it means that the 1.1 million households renewing in 2026 are on their own. The cavalry that mortgage brokers told them was coming is not arriving in time to matter for the renewal letters sitting in mailboxes across the country right now. The most dangerous thing a renewing borrower can do in this environment is wait. Inaction is a choice, and in the mortgage renewal process, inaction has a specific and measurable financial consequence. The borrower who receives a renewal letter and does nothing, who lets the anxiety of the situation prevent them from taking the actions that would improve their outcome, signs the lender's initial offer at the lender's initial rate with zero negotiation. The bank collects the full premium. The borrower leaves money on the table they cannot recover for 5 years. In the current environment, that premium is not a rounding error. It is a second car payment every month for 5 years. Act now. Shop your renewal. Ask for the discretionary rate. Use the stress test exemption to create genuine competitive pressure. And understand that the system rewards the borrowers who engage with it actively and extracts maximum value from the borrowers who do not. In our next investigation, we are delivering the grand finale of the Exit Tax series. We are going to expose exactly how the CRA, the Bank of Canada, the major financial institutions, FinTrack, and your municipal government are sharing financial data through a coordinated infrastructure that most Canadians have never heard of. Every trap we have documented in this series connects back to a single surveillance architecture: the principal residence audit, the retroactive reassessment, the renovation receipt review, the TFSA trading assessment, the Airbnb platform reporting. All of it is connected, all of it feeds into the same system, and that system is far more comprehensive and far more precise than most Canadians have ever been told. Subscribe to Canada Property Watch right now and enable your notifications, because that investigation will change how you think about your money, your home, and your relationship with the Canadian financial system from the day you watch it. The system is not a collection of separate threats. It is one coordinated system, and it is watching all of it at once.